Namaskar. Welcome to Daily Global Insights episode 278. A shout out to our viewers to like this program so it can reach its maximum potential. Today is Sunday, November the 14th, as we take a look at the markets. Sridharji, US markets rallied to close higher, yet posting a losing week for the first time in the past 6 weeks. So, what really happened last week, Sridharji?
Inflation. Basically, one specific number, inflation. I think inflation number, especially the October inflation number, has shot up. When you relatively look at the 30-year history, year over year, the October number was probably at the highest. The benchmark inflation rate, which Fed sets, is around 2%, but they have been very accommodative, and we have seen the inflation shoot past 4.2%. But the October number year over year is at 6.2%, driven by three factors: food, energy, and the general costs around the ecosystem driven by supply chain problems. So this what triggered the markets to respond, but nevertheless it regained momentum, and we finished the week on Friday. The markets finished higher relative to what happened in the prior week. But overall for the week, we were lower relative to the past 6 weeks.
And we will put up the markets chart at this point so people can see it for themselves. The October Consumer Price Index data showed its highest rise in 30 years, causing anxiety in the markets. Now, inflation is up, and so is the price at the pump, Sridharji. It's $5 now. For the first time in my life, I put gasoline at $5 a gallon. I've never done this. And it's just mind-boggling how quickly it's going up, even though the crude is only at 80. I remembered when crude was at 140, the cost was still $4.40. So somewhere somebody is padding big time.
Well, I think there's tremendous amount of flexibility at the stations. At two levels. One is the state taxes, which California is probably the highest around the energy or the gas, as we call it, in the United States. And the second is that there is some leeway for the gas stations to calibrate the prices. So this is what we are witnessing in the markets. Remember that we have been shut down for a long time. The markets have opened. So people are beginning to freely move about. So the consumption has increased while the logistical problems have remained. You remember, we also covered in the DGI logistics of those who are truckers not coming to work because of the vaccine mandates, etc., and supplies not reaching the gas stations. So this is probably a problem that is prevalent not just in the United States but across the world. And you are beginning to see the effects of it. And the other problem that has not been factored in because the mainstream media would like to, cover up on behalf of the Democrats is the chopping your own finger, which is namely cutting off the pipelines, cutting off the leases which were about to, go into new drilling. So you are effectively chopping the supplies at the most inappropriate time when the markets are beginning to or planning to rebound post-COVID, and you are asking the OPEC countries to lift their production to meet the U.S. markets. In fact, some Democratic senators and House members have suggested to Mr. Biden to release the gas from the strategic reserve so that the supply can be sustained without actually importing more from overseas.
The jobs data, which showed that 4.43 million people quit their jobs, even as 10.44 million job openings have been reported. Sridharji, are these at the entry level positions or is it at senior level, sir? Any idea?
No, Jim. Yeah, sorry. Complete your thought process, sir. My apologies.
No, I'm wondering, are these entry level positions or are they mid-level or senior level? What kind of jobs are not being taken up?
Mostly these are mid to junior level jobs. I won't use the word entry level. These are the services and casual as well as some of the jobs that we alluded to, which is namely the logistics, supplies, etc. They could also be healthcare workers, front-end workers, etc. Remember that there is a very stringent mandate, and in some of the democratic states, the mandates have been applied with ruthless efficacy or efficiency. So the challenge here is what we are witnessing for the first time in United States, which Janet Allen has talked about or alluded to, is we are seeing the what you call the regoggling of or the recycling of the jobs that are going on. While the inflation has shot up, the wages have not increased proportionately. So people are saying, I'm not going to be accepting the current pay structures. I'm not going to be accepting the mandates. That's one facet of it. The second facet of it is some of the changes that is taking place, particularly around the various programs that the present administration has, is also causing hiccups for people to say, this is where I don't want to be. I want to be moving to another state. So we may begin to see shift in employment to states which are far more what I call labor responsive and far more tolerant and accommodative to the employer employment policies. So this we have seen at least in a couple of countries in the past when the wave two hit those nations. And what we are witnessing is a similar kind of a trend in United States. But it's an astonishing number, 4.3 million people quitting jobs while there is a vacancy for 10.4 million.
And oil prices seem to have stabilized around the $80 to $82 mark, Sridharji. What does this mean? That there is more stability geographically, geopolitically now, or is there anything else?
Well, it just simply implies that the markets are recalibrating. They do not see an abnormal demand coming from the markets. When you have a demand supply dynamics, and when there's an abnormal demand, when supply has normalized, then you find that the prices definitely tend to go up unless the OPEC countries produce more and increase the supply. So what you're witnessing here is the existing supply is not reaching, and that is one of the reasons why you are seeing rise in prices. And even if you produce more, we have problems in two major areas. One is in the United States, and second is EU, European Union, which are large consumers of the gas. The logistics and supply chains with ships clogged around the ports and unable to reach the ports, most notably in the United States. We have no idea how many of them are oil and how many of them are other kind of supplies. So I think the markets have assimilated this specific factor, and which is why the energy prices have stabilized, nothing else and nothing more.
And 10-year bonds were trading in the 1.57% to 1.60% range. This is the federal treasury bonds, or is it something else, Sridharji?
It is a federal treasury bonds. That is the base indicator for us in terms of setting. We look at 10-year bonds and 30-year bonds, treasury bonds, and that effectively determines, in conjunction with the Fed rate, the market rates. The fact that the 10-year treasury bonds, which is the short term, which gives you much more around what the headwinds or what the tailwinds look like from a markets and liquidity point of view, is that it has not blown out. It has not yet reached the 2% which we were predicting by end of the year. But the peak did see 1.71%, and I believe that we'll eventually finish the year around 1.7 to 1.75%. But somehow the rates have held back, consistent with both Treasury Secretary as well as the Fed Governor, Dr. Powell's predictions.
And Bitcoin is trading at $63,655.20, and Ethereum is at $4,615.79. There are many other coins also in circulation. How are the others doing? And do you still predict Bitcoin to reach 75,000 by the end of the year?
I expect Bitcoin to be somewhere around that 65 to 75,000. We crossed 65 already. We went up to 67. I expect it to be around that 70 plus or 75, close to 75. I believe Ethereum will cross $5,000. There are other coins, but these two make up Dogecoin and so on. There are other coins. We can, as I said, we can do a separate show around the next wave of the crypto. What's happening around the crypto world is just beyond the coins. There's a new ecosystem developing, but we'll cover that. But these two make a bulk of the valuation, and clearly the crypto market cap has crossed $3 trillion already.
And European markets finished higher as global investors assessed inflation data from US and China. Europe itself has a challenge because of COVID. And what do you see in future? Is Europe a good investment destination?
Europe is a good investment destination. They have across Europe, there's some great companies ranging from consumer brands to energy brands to infrastructure to broad manufacturing, particularly the auto sector. And then, of course, you also have the renewable energy, which is one of the big areas of focus just coming out of the COP summit. So you can expect European stocks to perform better. There's depth in the market, plus there is enough liquidity, and it is a good alternative to the US markets in terms of very similar behavior, consumer spend, cost of funds, inflation, etc. So I think I expect Europe to do well. In European markets went up across the three indexes when the numbers, you can see from the numbers, and predominantly, very interesting, predominantly driven by the sentiments in consumer behavior and consumer purchases, or household purchases as we call it. It was a dip in the market, or the derailers was very significantly influenced by the energy prices, because the reason is that the higher the energy prices, lower is the disposable dollars that's available for anybody's spend. So I think the European markets followed a consistent pattern very similar to the US markets.
And let's take a look at Asian stocks. Asian stocks rose as tech shares rose, driven by Nasdaq and positive sentiments in the tech stocks in Singapore, Hong Kong, and Korea. Now, some of the tech companies are now headquartered in these cities, isn't it? I think, for example, Applied Materials is headquartered in Singapore, if I remember correctly.
Correct. You're absolutely correct. Some of the shifts have taken place by virtue of changes in the Hong Kong market post Hong Kong full complete acquisition by China by way of owning the markets, which it had kept up until recently fairly at arm's length, but now it is completely under the government control. It's important to point out that when we use the word broadly tech here, the word that we have to think about here is semiconductor. There's been growth in the semiconductor, and that has spread around from Korea to Taiwan to Japan, especially the deal that has been done by Samsung, and also by Samsung. I think is shifting some of its production or expanding its production, as well as some of the TSMC partnership in Japan. There's also expansion in Malaysia and Singapore and in Vietnam. The other area where there is also expansion here is robotics and artificial intelligence investments in these specific markets. Then also the electronic vehicles, as EV is a very big growth area within Asia. So you are beginning to see the positive growth effects from capital flowing in, or capital being allocated into the next set of what we call as the tech expansion, which is around robotics, which is around drones, which is around AI, which is around the next generation semiconductor chips, and which is also around some of the artificial intelligence technologies which are needed to power these institutions. So very much it's a tech-driven, and Asia is very much a tech-driven economy as opposed to the broad other sentiments that we are like construction or household spend, etc.
And earnings season has drawn almost to a close, and we can expect some stability as we work towards holiday season and the end of the year.
My thoughts on that is the earnings season is complete in most markets for the third quarter. Doesn't matter whether it's Europe or India or Asia or United States. We are seeing very positive momentum in the retail spend. Already the online spend is up close to 8% relative to last year. Last year, if you recall, we had record data, notwithstanding the fact we had COVID, because everybody went online. I mean, we did close to almost $1 billion just in the holiday shopping season, which immediately kicks off on the Friday after the Thanksgiving and runs past the Christmas, past the New Year into first week. That's what is called as the holiday season in the United States. So the early sales has picked up, indicating very positive number. We will get, notwithstanding very negative consumer sentiments, it has not flipped into the consumer buying within the sector. But a lot of information we will get to know as the retail sector reports its earnings and gives us the forecast next week. Home Depot, Walmart, they're all expected to report earnings next week. But we don't see, already we are at the record levels in the indexes. These sentiments are only going to allow it to move forward. But with the earnings season complete, we may not see a significant amount of uptick, but we could be in for a surprise if there is, contrary to the consumer sentiments, if the sales disproportionately take off.
And despite supply chain niggles and COVID threats and inflation, early shopping online has commenced, and retailers expect an 8% jump in holiday sales this season, which is what you predicted, Sridharji. Indian markets edged percentage point higher in each of the 2 weeks ending November 12th and the prior week, boosted by technology, energy, infra, and auto sectors. Sridharji, India is humming along, isn't it?
India is humming along, and I think that the at a macro level is what we don't do micro at a stock level, but at a macro level, India is very much tied to the rest of the world in terms of inflation and rates. That's number one. Number two, it is unique to some extent. It looks at, because it is an economy which is on a trajectory from 3 trillion to 5 trillion. So you will begin to see stocks in the infrastructure sector. You will begin to see growth in the auto, which has been one of the drivers. Then you will begin to see on the tech sector, as well as in the energy sector, because the renewable sources of energy, there is a tremendous progress that is going on in the Indian market. The banking system has always been clogged with credit expansion, so you may see some headwinds in the banking sector depending on how that is managed. The second is the pharma sector, I think, has seen enough amount of momentum and growth factored into the pricing of, unless you see a new export or new significant amount of demand, the pharma sector will finish where they are right now. These could be the two derailers, when I say derailers, within the context of the overall drivers. So I think Indian market has done exceptionally well, very much aligned with, let's say, the US markets and probably the Asian markets.
And Indian warning season is complete, and markets will watch for more cues from the inflation data and other global cues. Sridharji, overall, I think India is on track for like 10 to 11% this year.
Yeah, I think it is on track to achieve that specific number. But as you can see from US is equities, US is the most stellar market. 25% is the S&P right now as we stand. Dow and Nasdaq is around 16 to 18%. It is hard to beat the US market in the equities.
And that brings us to a close of today's look at markets. Every Sunday, we'll be looking at markets in this kind of a depth. Thanks for joining, and do please like, share, or subscribe to our channel and click on the bell button. Thank you, Sridharji, and we'll be back Monday morning, same time, same channels. Namaskar.
Namaskar. Thank you so much. Have a wonderful day, wonderful Sunday. And we look forward to seeing you tomorrow morning, New York time and or West Coast time, and tomorrow evening, India time, and depending on your time zone, afternoon or early evening or early night in around the world.
Thank you very much, sir. Namaskar.